Imagine a market so stable, so boring, that it hasn't changed in decades. Now, imagine a sudden $30 billion explosion that leaves the world's biggest giants scrambling for cover. Welcome to the Great Reshuffle of 2026. This isn't just about feminine care. It's a high-stakes chess game where one wrong move costs billions. We at HDIN Research have spent months digging through the wreckage of 2025 to show you who's actually winning and who's just burning cash. First, let's look at the old world. For years, this business was like owning a gold mine. Once a customer picked a brand, they stayed for life. It's protected by high-tech patents and a retail footprint so deep it's practically part of the city's plumbing. But even the strongest fortress can be built on shifting sand. But here's the wow factor. Edgewell just saw their revenue collapse by nearly 8%. In corporate terms, that's not a dip, that's a crater the size of a small moon. Why? Because the world is changing. Birth rates are falling faster than a tech stock in a recession, and the raw materials needed to make these products are getting as expensive as luxury watches. The industry is trapped in a pincer movement. So what do you do when the floor starts shaking? You have three choices. Double down and buy your neighbors, consolidate, replace your expensive human staff with robots, automate, or simply pack your bags and leave exit. We're seeing all three happen at the exact same time. It's a corporate survival horror movie. Look at this gap. P&G is the Everest of this industry, sitting on $5 billion. To put that in perspective, that's enough money to buy every single person in London a high-end dinner. But look at the others. They are tiny by comparison. Until now, the Kimberly-Clark Kenvue alliance is basically two smaller predators teaming up to take down the T-Rex. Now let's talk about bread and butter, or how much money actually stays in your pocket after the bills are paid. Kenvue is the efficiency king here, keeping 25 cents for every dollar they earn. Meanwhile, Edgewell is struggling to keep even 6 cents. When your pocket change is that small, you're not running a business, you're running a charity for your suppliers. Kimberly-Clark isn't just buying brands, they are buying science. By merging with Kenvue, they are taking the medical trust of Tylenol and Listerine and sticking it onto a pad. It's a brilliant move. They aren't selling you a commodity, they are selling you a clinical solution. And they're betting $350 million in savings that this will work in China. Then there's Edgewell. They've decided to walk away. This is the tactical retreat of the century. They're selling off their entire unit for $3.4 billion, enough to buy a professional sports team just to get back to what they know best, shaving. Sometimes, the smartest move in business is knowing when to stop fighting a war you can't win. Now let's talk about the biggest battlefield, Greater China. It's a tale of two strategies. In the mainland, it's all about premiumization, selling fewer things, but making them much more expensive and fancy. In Taiwan, China, it's about direct-to-consumer digital warfare. For these giants, winning here isn't optional. It's the difference between growth and extinction. Going green used to be a marketing gimmick. Now it's a billion-dollar tax. New laws mean plastic is the new enemy. Kimberly-Clark is dropping $1.5 billion just to get plastic out of their products. That's a massive green premium. If you don't adapt, the regulators will shut your lights off before the customers even have a chance to switch. Time for some cold humor. We found some holes in their pockets. Edgewell admitted their assets were worth $51 million less than they thought, right before they sold them. That's like trying to sell a used car and admitting the engine is missing at the last second. And look at Kenvue's inventory. Their warehouses are filling up faster than they can sell. Watch out for a big bath write-off soon. So what's on the horizon for 2026? It's a sprint. By Q1, we'll see if the KC and Kenvue marriage is a honeymoon or a disaster. By Q4, we expect industry margins to hit 22% as the robots take over the factories. The era of cheap, low-tech pads is dead. The era of high-margin automated care is here. The conclusion is simple. This is the survival of the scaled. If you don't own at least 30% of the market, you don't have enough muscle to survive the R&D costs. Growth isn't about selling more boxes anymore. It's about making more money from every single box you sell. As we always say at HDIN Research, the future isn't about selling products. It's about managing life cycle transitions. The companies that understand they are helping people, not just selling fibers, are the ones that will be here in 2030. That's our deep dive. If you want the full-page data set, the kind that makes CFOs sweat, reach out to us at sales@hdinresearch.com. Or visit HDINresearch.com for more. Don't forget to like, subscribe, and tell us in the comments, which of these giants do you think will fall first? I'm from HDIN Research. See you in the next analysis.